Today, we're going to be discussing the upcoming FOMC meeting. That's the Federal Open Market Committee meeting. That's going to be taking place on Wednesday, June 17th. So essentially what we're going to be discussing is there's a lot of noise, there's a lot of pundits, there's a lot of talk going about what's going to be happening on this one because there's a lot of good news. The new Fed Chair is going to be starting, Warsh. And then we also have the old Fed Chair who's still going to be present. So that's going to be interesting with all that noise going on. But I think what our job here today is going to be to separate that noise from the substance. So Mike, I guess what we want to start off with is, let's start with the basics. What is the Fed trying to accomplish with these meetings and what is their goal?
Yeah, so the Fed has a dual mandate. It's full employment and stable prices, which is loosely defined as 2% core PCE, personal consumption expenditures. And that's what when they're looking at policy decisions during these meetings, it's really about achieving those goals and seeing if one of them is outside kind of the target number that they're looking for. And that's really what's getting discussed and what the policy actions are trying to focus on.
I mean, speaking of those outside numbers, I mean, if I can quote some current statistics to you, some of the things that I was very shocked by. So inflation came in 4.2% for May, which was higher than 3.8% for April, which is the third consecutive month of acceleration. Then we looked at the jobs number that came in that kind of crushed expectations, which came in at 172,000. So I guess what I want people to understand and what we should be on the lookout for is, should we be expecting cuts or should we be expecting hikes from this upcoming meeting?
Yeah, I think neither, actually. I think there's going to be no decision or they're going to keep rates the same.
Great answer there.
I mean, just kind of going back to the data, right? Not only was this past month's number strong, but the prior number was revised up. And then on the inflation side, you were quoting headline, the Fed cares maybe a little bit more about core. And core was, around 3%. So, adjusting for the differences in PCE versus CPI, it's still above their 2% target. So, if you think about the Fed's dual mandate, the unemployment rate, was 4.3%. So the dual mandate is showing that inflation is still above their targeted level, and the unemployment rate is kind of staying the same, so stable. So given the current environment, I think the Fed will do nothing and watch, just given what maybe some of the drivers of that inflation currently are.
I guess that'll be interesting. We'll see, because you're right. The data is pointing to where we have no idea where it's going to go. It should stay the same, but we'll see what they end up doing. I guess that brings up a good point, though, in terms of what they're going to be doing is, let's talk about Fed independence. So one of the things that's been talked about, I don't want to say recently a lot, is the current administration's goal of trying to get the Fed to have cuts. And essentially what they're trying to do is they want to spur growth. Now, the new Fed Chair coming in, that was kind of the expectation that was coming in. So I guess when I pose this question to you about Fed independence, is there a chance that they're going to remain independent, or is it going to be kind of going with what the administration kind of wants?
I think they'll remain independent. Again, it's Warsh is one vote of many. And so he needs to build consensus to actually have policy shifts. And, like I said, the data right now speaks to maybe a little bit more concern on the inflation side, or you could argue where that inflation is coming from. It's not really coming from wage growth. So is the Fed going to react to...
I mean, a lot of it's going to be energy.
It's energy, it's
related,
AI,
so
and the AI demand is inelastic. That's not going to change by 25 basis points of a hike. And so I just don't see Warsh coming in and trying to, at least during the Q&A afterwards, trying to really push this dovish environment, because I think that's going to really harm his long-term credibility. If he comes out and is talking differently than what maybe the statement that was kind of discussed by the entire committee, and he's talking a little bit more dovish, when in reality you could argue that they need to be neutral or hawkish, long-term credibility for him is going to take a hit, and you probably see that getting impacted out the yield curve. Because if the Fed does move rates, or they somehow can push through rates cuts in this environment, I don't think that's the case. I think that has pretty big implications for longer term interest rates.
So I guess your expectation is he should say status quo, essentially.
I think
let's not kind of rot the boat.
Yeah, if I were to say, you have dovish, neutral, and hawkish, he needs to be neutral to slightly hawkish.
Got it.
Just given all the commentary from the Fed officials, they want to remove specific language. They want to tweak the verbiage, if you will. You can't come in and then talk about cutting interest rates when every other official seems to be at the neutral to higher interest rate leaning.
Well, that makes sense. I guess down the road, maybe not this meeting, but maybe some of the next meetings, maybe in the next 6 months, what do you need to see, I guess, in the data to make you think that we're going to have either hikes or cuts? And I guess, how does that impact bond investors from a risk perspective?
Yeah, so we can paint two different kind of scenarios. So in the hiking scenario down the road, I think you really have to see inflation start to creep into some of the core services that you do have in the goods area. I think that's where, maybe wage-induced inflation is going to be concerning for the Fed. Long-term inflation expectations are still anchored. But if those start to creep higher and you start seeing inflation in other areas maybe that weren't directly impacted by and sustained inflation directly impacted by energy prices, that's when the Fed's going to get concerned. They're going to have to seriously consider increasing interest rates. On the flip side, for the Fed to cut rates, you're really going to have to see a deterioration in the labor market, which again seems to be strong.
Which we're not seeing right now. Yeah.
Yeah. We've always thought that the Fed would be quick to aggressively cut rates, or even not aggressive, just cut rates if they saw cracks in the labor market. Until you see that, if you're going to stick around sub 4.5% unemployment rate, the non-farm payroll data, the break-even's lower because of immigration. But if you start, you see that staying consistently at 50-ish, give or take, and less 4.5% unemployment rate, Fed's not going to move. But if you start seeing those numbers falling and the rate going higher, I think it's in play for further cuts.
Well, I guess when you say it like that, I guess how should bond investors, again, as I mentioned in the opening question was the risk, how should we be positioned given those expectations?
Yeah, I think if I was looking at the curve, there's still a lot of uncertainty out the yield curve given some of the fiscal issues and the inflation issues. So just be a little wary of what you're owning out the curve, I guess, from our perspective. There's still, from a spread perspective, we talked about, all the risks in fixed income investing. And spreads are fairly snug, at least how we measure them. And so just be very, very aware because, market pricing and the data can change very, very, very quickly. And you just have to make sure wherever you're going to buy fixed income, you need to understand what risks you're getting exposure to. And that's going to definitely drive returns.
Well, I think that about wraps it up. I think it's going to be an interesting Fed meeting, to say the least, on Wednesday the 17th. Please join us next time where we're going to recap exactly what was said and expectations going forward. If you have any other questions or need any other information, please visit MadisonInvestments.com. Take care.